What's up, team? Okay, so in today's video, we're going to go over a really powerful options tutorial for beginners. Not only do we go over the basics like the Greeks and all that stuff, but we're going to go over in detail multiple different strategy examples so new traders can really learn how we profit with options. The host of this video is Austin. You can find all of his content and links in the description to check out. Be sure to hit that like and subscribe button for support. And without further ado, let's take a look.
Hey team, this is Austin, longtime subscriber and daily viewer of the Beginner Trading channel. I'm here today to go over some option strategies that I use daily and that I believe are very profitable if put into practice correctly. This is part one of hopefully a mini-part series that will give you guys some of the tips and tricks needed to profit consistently in the options market. Remember, I'm not an investment professional. I'm just sharing my personal experiences through hundreds of hours of chart studies in an attempt to help y'all make profits in other ways than just the typical stock trading. Without further ado, let's hop right into it. So we have a question that is very important. Why buy stock options over buying the stock outright? Well, the simple answer is because it requires less upfront capital needed to enter a trade while still being able to control large share sizing and the profits from them. Each contract is controlling 100 shares, thus potentially giving you larger profits with a smaller investment. Here's an example. I believe VIAC, which is Viacom CBS, currently priced at $43, will have a jump in price sometime in the next 2 months. So, we are going to buy this company's stock. In 45 days, the stock pops to $63. Both examples sell at the high, and this is how it worked out. Below is the math for buying stock versus buying stock options. When you buy a stock outright, you pay the price per share, and you can hold it as long as you want or sell it right away. Your profit and loss is determined by the amount the stock price goes up or down, compared to your average price per share that you bought at. If we bought 500 shares of VIAC, which is currently around $43 a share, we will have an initial investment of $21,500. Now in the example, the share price jumps to $63, and we sell our 500 shares for a $20 per share profit, which is great, and you just made $10,000. Now onto the options side. Same scenario, but with options contracts. If you don't already know, a call option is when you expect the stock to go up, and a put option is when you expect the price to go down. So we go to your broker's option chain, and we find a 2-month expiration $60 strike price option for VIAC, which is currently priced at 45 cents. Now, most brokers that I'm aware of show prices in this format, but you have to remember, one options contract is controlling 100 shares of said stock. So you will need to multiply these values by 100, or just move the decimal point 2 places to the left. We buy 50 call contracts, which controls 5,000 shares, 100 shares per contract, at $45 a contract, for an initial investment of $2,250. Again, same scenario, VIAC jumps to $63 in 45 days. At current prices, $3 in the money contracts with 2 weeks time left are going for $375 a contract. We sell all 50 of our contracts and collect $375 per contract for a total gross profit of $18,750, and we subtract the initial investment of $2,250, and our net profit is $16,500. As you can see by our examples, neither example is bad. They both were very profitable, but comparing the initial investments and looking at the profits made off the same move by the stock, the option trade made 60% more profit with close to 90% less upfront capital. But there is a catch. Options are inherently more risky due to the fact that they have an expiration date, which is a very important factor to keep in mind when selecting an options contract. Here are some common mistakes and/or misconceptions people make when trading options. One of the biggest ones I would say would be that some may not realize that you can buy and/or sell options just like stock. You can day trade, swing trade, or hold for the long term, which is called a leap contract, defined as usually more than 6 months of time until expiration. But one key difference that I've learned is that when closing a trade, it only takes 1 day for your funds to settle instead of typical 2 days from stock trading. I'm not sure why this is, but I know it to be true on the platform I do most of my option trading on, which is Webull. You can buy out-of-the-money options for cheap, and if the stock pops but doesn't reach your strike price, you can sell at any point to close the trade and collect the profits. And the reason this works is because an option has two values, intrinsic and extrinsic. Intrinsic value takes into account how much in or out of the money the contract is, an extrinsic value, which is derived from time until expiration, demand, and volatility. So a stock currently priced at $10, you find a $15 strike 1 month expiration option for $25. It only has extrinsic value and no intrinsic value, being as it's out of the money. Then the stock jumps to $14 in a week. The option still has no intrinsic value because it's still out of the money, but the extrinsic value has risen, which moves the price of the option. Time is your friend. When looking for which options to purchase, check different expiration dates. The price per contract may not differ much, but it gives you more time for the stock to make its move, which in the options world is like gold. Paying too much for in-the-money options. Now this one is more of a judgment call on your personal risk level. In-the-money options are less risky because you're already in the money, and it holds both intrinsic and extrinsic value. But they are much more expensive, and personally, it's not the style that I trade. This is another big one. Take profits. The sooner the better. If you buy a 1 month contract and the stock jumps 10 to 50% in a week, sell it. Take your profits and move to the next trade. I am guilty of this one far too often, where I'm trying to always hit home runs. And sometimes they work out, but lots of times I leave good money on the table. Set your risk level and stick to it. If the stock price falls below the support level you bought near, sell the contract for a small loss and move to the next trade. There's always another trade. Be careful buying large cap stock options too far out of the money. If a contract is too far out of the money, it will take a massive move to outweigh the time decay. I will explain how to help determine this in the next slide. The Greeks. No, we're not back in college. The Greeks are values given to each contract, which helps traders understand risk levels. The main three that I use are delta, gamma, and theta. There are others such as vega and rho, but we won't be using those for this strategy. All of these values are fluid and change as the price of the stock changes. Delta. It's my favorite value to use because it tells us how much the value of the contract will change with a $1 move up or down in the underlying stock price. You can have a range from 0 to 1 on call options and a range from -1 to 0 on put options. Gamma is how much the delta will change with a $1 move up or down in the underlying stock price. So if you have a delta of 25 and a gamma of 5 and the stock price goes up $1, the delta will become 30 and the gamma will go up as well based on a different Greek value that we're again not using on this particular strategy. Theta is the one I like the least because this represents time decay. This value shows how much the contract price will depreciate every day until expiration, even on weekends and holidays. The theta grows as the expiration gets closer or further out of the money. Theta is always eating away at your extrinsic value, so be careful. Remember, these values are all times 100 since it's 100 shares per contract. Most brokers do not convert them for you, so you will have to get used to doing it on the fly. Now that we all have a basic understanding of options and how they work, this is one of my favorite strategies that I use every day when looking for my next trade. I call it the drop and pop. I'm sure there are more technical names, but this is what I like to call it. Firstly, we are looking for a large drop in a short amount of time, as long as it isn't due to major negative news, which could be bankruptcy filings like Hertz, a major scandal in the company, looking at you, Nicola, or even a drug trial gone bad or not approved by the FDA, or any other major company crumbling negative news. Things like bad earnings or short reports, I don't consider those major. The move should be at least 15 to 20%. Once we see the large drop, we should add that stock to the watch list to keep an eye on it. We should then wait for the bleeding to stop and a clear bottom is made and confirmed. This could be past support levels or new support levels that are made after the drop. Then we allow the stock to show signs of reversal. I use multiple different ways to tell this. If you trade stocks, you should know signs of a trend reversal. Higher than normal volume, ascending supports, bull flag, double or triple bottoms. Use what you're comfortable with or what you have been using for trading stocks. We will look to buy on that reversal signal. We set our risk level by setting a stop loss right below the bottom with maybe a few cents to spare, and stick to that stop loss because we can always find another trade if this one doesn't go our way. We buy our options dependent on your risk level. It may be 1 to 6 months until expiration, and the strike price may be in or out of the money. That can only be defined by you. Then, all you do is wait for the pop. This is what I'm looking for when selecting options using this strategy. Length of contract. With this strategy, I personally look for at least 1 month to 3 months until expiration. If possible, stick to the monthly contracts, not the weeklies. This should be indicated by each broker a little differently. The longer the length of contract, the less risky it becomes, due to having more time until expiration, which gives the stock a chance to make its move back up. Strike price choices will vary from person to person depending on their risk level. The further out of the money an option price is, the more risky it is. The further in the money an option price is, the less risky it is. What I am looking for personally when using this strategy is a good price to delta ratio. Basically, I want the stock to move as least amount as possible for me to at least double my investment. In the money strike prices are less risky and have a higher delta value, but they are more expensive as well. We should also pay attention to the other two Greeks we learned about, the gamma and the theta, as they both give you valuable information in order to make informed decisions and identify your risk level. Let me explain the price to delta ratio I spoke about earlier. I am looking for a 1-to-1 or 1-to-2 ratio if possible, which it's sometimes not depending on the stock. What this means is that I want the stock price to move the least amount possible for me to at least double my investment. An example is, if the option price is 50 cents, which is $50, and the delta is between 25 cents and 50 cents, then I've found a good deal. So what this tells me is that the stock will only need to go up $1 or $2 for me to at least double my money. With large cap stocks, this will almost be impossible due to the pricing of the contracts and their volatility. Go look at the price to delta ratio for GameStop and or AMC and you will see what I mean. I'm going to go over some examples of this strategy. Some that I've played personally, some that I've missed out on, and others that I believe are currently setting up for big moves. From November 2020 to January 2021, on this 1-hour chart for ARCT, there were 3 plays, possibly even 4, using this strategy. Can you spot at least 3 opportunities before I point them out using the info in the previous slides? Okay, well, here's 1, here's 2, and here's the 3rd one. But I'll go over the ones I traded in better detail. Stick with me here, team. This is where the good stuff starts. The first opportunity. We see a large drop from a resistance level of near $60, which has been confirmed 5 times from May to November, as you can see by the blue arrows. 1, 2, 3, 4, and 5. Down to a support level that has been confirmed 3 times before this move, as you can see by the yellow arrows. 1, 2, 3, and 4. Once we see the move, we should confirm there is no major company crumbling news. In this case, it was in anticipation of bad earnings, which turned out to be true. Now we are looking for our opportunity to find an entry point. A bottom has been made, volume is still high from the major drop, and we are seeing signs of a reversal. Here's a zoomed in chart on the 5-minute time frame, as you can see by the yellow rectangle. When to buy. We are looking to get in low before everyone else sees what's happening and drives up the price of the contracts. That way, we can not only take advantage of the price moves, but also the extrinsic value increase from the influx of buyers as most wait for the breakout to buy. Basically, the more popular the option, the more it will cost. We are looking to enter as early as possible, to beat out the higher cost for popularity. Once the earnings were released, the move had already happened and was already priced in, but the volume stayed abnormally high. We see a bullish pattern forming on the 5-minute chart. We see a double bottom on the day of the drop and a small run in after hours, which tells me the buyers are ready to step in. Then, the next day, an ascending support level after the drop, indicating a possible trend reversal. On the 3rd test of this ascending support level is where I bought, indicated by the green arrow. On this play, I bought a 1-month expiration $60 strike for $45. Now on this play, I held until the move slowed down, and I sold on the pop to a previous resistance level indicated by the red arrow. I missed a very large profit opportunity, but I still walked away with over 1,000% in profit, which I'm very happy about. But if I would have held 2 more days, I would have made much more than that. But this goes back to the taking profits early. This is one example of how a move can continue, but many times you will lose the profits you've gained if you do not take your money off the table. Our second opportunity happened on December 1st. We see a large drop of nearly 25% in one day from a recent high of near $100. We confirm there is no major negative news. We wait for the bottom to be made and confirmed, which happened near $75, indicated by the yellow arrow. Then we look for signs of a reversal. After a quick pop of a few dollars the morning of the 2nd, we saw a triple bottom forming, which is kind of hard to see from the picture, but trust me, it's there. But I look to buy on the third test of that bottom, not on the breakout, since I'm trying to get in before everyone else drives the price up. This entry is indicated by the green arrow. We will be looking for a strike price between $75 and $100, which was the length of the drop, with at least 1 month of time until expiration. We set a tight stop loss of a little bit below the bottom that we bought at and sell the contract if it drops below it, because remember, there's always another trade to make. The same day I bought this option, it jumped from $82 up to $98. Now for this strategy, I would suggest taking some profits here. If you bought multiple contracts, sell half or however many you're comfortable with, which will regain your initial investment, and then you can play with house money the rest of the trade. Heck, since it's house money, you could hold the rest for a home run. If, and only if, your previously defined risk level allows you to do so. Because as you can see on the chart, over the next 2 days, it jumped from all-time highs near $100, another 25% up to $125. But this doesn't always happen, which is why I suggest taking some profits on all good pops. Now on to opportunity number 3. Again, we see a large drop, this time of over 65%, from all-time highs near $125. We check for any major news. In this example, there was nothing major. We then wait for a bottom to be made, which happened near $40 on December 28th when the market opened, which was actually a support level from early in October, as shown by the yellow arrows. It stabilized and then made another test of that same bottom near $40 the next morning. We then look for signs of a reversal, which over the next week, the chart shows higher highs and higher lows being made, which can indicate a reversal. We will look to buy once we recognize a bullish signal, which in this case was on January 1st near $44, as shown by the green arrow. We look for a strike price between $40 and $120, which is the length of the move down, with at least 1 month until expiration. On a move this big, you will want to pay close attention to the price to delta ratio, as the recent volatility has artificially raised contract prices. Closer to the money options will always have a better price to delta ratio. Once you have determined the correct contract for your risk level, make your purchase and wait. But be careful, because if you choose a strike price that is too high, it may come back to bite you. After you buy, we set a tight stop loss near the bottom we just bought at, which is near $40. Let's look at a different stock here for our fourth example. The 1-hour chart on FUBO from December and January. We see a major drop of close to 60% in a week, from $62.50 down to $23. We check to confirm no major negative news. We look for a bottom to be made, which happened on my first yellow arrow. And what followed was a higher high, higher low, and then a triple bottom, which are indicated by my next 2 arrows. On the third dip, to test that new support level is when I look to buy, as indicated by the green arrow. And I start looking at the option chain for a strike price between $25 and $60, which was the length of the move down. I'm also looking for a good price to delta ratio and a contract that is at least 1 month until expiration. Now I personally traded this move and I chose a strike price of $40 and a 1 month expiration, which was February. I paid $50 per contract for this option. I set a tight stop loss of the recent bottom made by the large move down of near $24. But what was interesting about this example is the exit. There are a lot of ways to play this, and this is how I did it. None are wrong unless you lose money after the first pop up. 2 days after purchase, we see a good pop from $27.50 up to $40, which had resistance from earlier in the month on the drop. I moved my stop loss from $24 up to $30 based on the info the chart has given us. So I risked losing the $10 change from the $40 down to $30 because I had a high conviction in the company at the time. It paid off. A week later, the stock jumped from $30 up to $57.50. I ended up selling the contract when the stock price was near $50 a day later for over $1,000 per contract profit. Not bad for $50 initial investment. Thanks for watching, team. I apologize for throwing so much info at you guys, But these are the basics needed to understand how to find options within your risk level using the drop and pop strategy, and understanding how the options pricing differs from stock pricing. If anyone does not already have a Webull account and would like to sign up and get free paper trading, free stock and options trading, and use the same platform that I use, sign up now to receive up to 4 shares of a random stock valued between $300 and $300 for the current promotion. See you guys soon, and happy trading.